Welcome back to the Biz Beat by SVA, where we break down the latest tax and policy news and what it means for business owners. I'm Lee Schwartz, Director of Business Development and Sales here at SVA Certified Public Accountants, and joined as always by Eric Trost, Tax Principal and our firm's President. Eric, how you feeling this week?
Pretty good. How you doing?
Good. I wasn't sure if you'd be all upset after, what happened last week. And just to bring everybody up to speed, if you didn't listen to last week's episode, for the first time in my 14 years here, I asked Eric a tax question and I stumped him, which is like, that never happens. So Eric, let's actually start there so we can update our listeners. We were talking a little bit about three of the main talking points from the campaign trail: no taxes on tips, no taxes on overtime, and no taxes on Social Security. And I asked you, are there phase outs? Can you provide our listeners an update? What are the phase outs for those?
Yeah, I will provide an update. I go back. No, I wasn't too upset about that, Lee. We just have gone to mandatory scripting of questions now, so it never happens again. But occasionally I am asked a question that I don't know the answer to. So then I do pull out my trusty ChatGPT or Grok and start doing some research. But mind you, that's not the place you end for research. That's only the place you start. Anyway, on these phase outs within tax law. So you have to understand this. And this is a conversation I've had with many folks before, especially those that, know a little bit about the tax law, but don't work in it. You get some misconceptions. And that's because there's different approaches within tax law, and one of those approaches happens to be phase outs or, cliffs. Sometimes within tax law, it's a cliff. Like if you reach a certain amount, you just can't do anything anymore. So you reach too much income, you can't do anything anymore. But sometimes there's phases, and in this case, there is phases. So what that means is for the no tax on tips, no tax on overtime, and no tax on Social Security, which, as you recall, is really not no tax on that, but it's special deduction for seniors. They are phased out. So what does that mean? When you reach, and I'll just use a married couple now, but you can cut these amounts in half for single. But when you reach $300,000 of income for both tips and overtime, you start to lose the ability to take that deduction. But it doesn't go away completely. It goes away over time. And so for each of these, it goes away by the time your income hits $550,000. So it's somewhat of a complicated calculation, but it starts to go away at $300,000 and it's completely gone away at $550,000. And anywhere your earnings are in between there, your deduction is limited through a more complex calculation. For the no tax on Social Security, which again is just an enhanced deduction for seniors, that deduction also phases out, and that phase out starts at $150,000 and goes up from there to, I think it was $250,000 that it's totally phased out. So there's a phase out for the deduction for seniors that goes over time as well, or over an income range as well. So it doesn't just disappear at a cliff. It goes over time where it slowly phases out. So there's benefits there, even if you're over the initial marker, but it's just more complicated to calculate what your benefit is because it's a reduced benefit until you hit the top of the phase out range, in which case then it's all gone.
Okay. Thank you for providing that clarification. I know that's important to think about if any of those things apply to you is, do I have to keep this in mind? And essentially what I'm hearing you say is these phase outs mean like you go with the flow and wherever you fall is where you fall. But it's not like if you're at $298,000 in income, you really need to be thinking about, well, I have to stop doing whatever I'm doing because there's some major thing that's going to affect me. Essentially, it's a slow burn.
Yeah, that's right. That's unlike the tax rates where when you kick into a higher tax bracket, so your income is taxed along the way, but as soon as you get to that higher tax bracket, your next dollar of income is taxed at that higher bracket. Not all your income, but your next dollar of income. And that is a cliff. Once you go over certain marks, boom, it happens right away. That's not what this is. This phase out means that over your income range, it starts to slowly phase out, which means you can go over the initial phase out amount or initial floor, let's call it, but the ceiling is still much higher, and you can still take deductions along the
Okay,
way.
great. Thank you for that. And then let's get back to sort of our normally scheduled programming here. Typically, we go through a couple of main topics, and then we answer a mailbag question. Eric, there's been a lot of conversation over the last week about tariffs. We've seen deadlines come and go. There's been conversations around trade deals that, depending on who you ask, either have passed or have not passed with different countries. Can you give us just maybe a real brief overview on where we stand here today when we're recording this on Tuesday, July 29th?
Yeah, so there's a couple countries that more or less have trade deals announced. Um, it's hard to say announced because there's two parties that can make the announcement. There's the United States on the one side of the trade deal, and then there's the other country on the other side of the trade deal. I would say that Trump likes to get something announced as soon as maybe the clay is kind of formed, but maybe the final product isn't done yet. Not every country's leader takes that approach. I'd say Trump is more aggressive with that. But he has announced trade deals that I think the European Union has pretty much agreed to. There's still details to work out. So there's a trade deal with the European Union at 15% tariffs for goods coming in from the European Union. There's a trade deal with Japan also at 15%, although it sounds like there's even more details to be worked out there yet. So those two countries, major trading partners, look like they're going to have trade deals in place. Other major countries, though, that don't have a final trade deal in place are China, which has a temporary trade deal in place, but that only lasts for another couple of weeks here, and India, another large trading partner that they have not come to a final trade deal with, and Canada. Canada's holding out. I think they're trying to play hardball. They are, I think, has been unresponsive somewhat to the opening of the trade talks. So I don't know how that's going to end up for them. But I think that what you'll hear in the news next is I think China and India are going to be priorities. Those are large trading partners. Canada is not so large a trading partner for us to them. It is for them to us, but not for us to them. So maybe they're not going to press that one. I don't know. But I assume China and India are going to get big press because they are large trading partners.
And depending on what industry your business is in and where your suppliers are, this can either have a huge effect on you or not so much. And I guess, as always, Eric, we've talked about this a lot, but I imagine your continued advice is pay attention to what's going on with those countries and the suppliers that you have that trade with those countries. Know what's happening, stay on top of it, have other options available if needed. Correct?
Yeah, I think that when these finally settle in, and the market's a clue as well, the stock market, if they seem to be pricing in now, maybe some of these trade deals happening. So the swings that we saw earlier when the trades were first announced, that's not really happening right now. So I think the market's somewhat pricing in, we'll call them somewhat normal trade deals, but definitely different than it was in the past. Significantly different from the standpoint of there used to be a lot more free or low tariff agreements. That's just not going to be the case anymore. It sounds like from, even if favored trading countries like the European Union get hit with a 15% tariff. Great Britain is 10%. A lot of those used to be much lower than that, less than 5. So I think there is some sense of we are going to get back down to trade deals, but it's not going to be like it was, but they are seeming to stabilize if the market's an indication then of where expectations are.
Okay. Well, stay tuned. Lots more information to come there. We'll keep talking about these as new trade deals become available. But Eric, the last few weeks we've dived into a couple of different aspects of OBBBA, the One Big Beautiful Bill Act. Last week, as we talked about already, we talked about the no tax on tips, no tax on tips, no tax on overtime, and no tax on Social Security. This week, let's dive into some of the enhanced deductions that are available here. Maybe let's start on the auto loan interest deduction. There was some changes there. Can you give us an overview of what that is and how that's going to affect people?
Yeah, so there's I've been doing tax returns for quite some time. People used to say to me, "Hey, do I need my auto loan interest?" I was like, "Well, why would you need that? That's not deductible because that's the old days." It actually used to be deductible in the old days. So pre 1986, you go back to pre 1986, and auto loan interest was actually deductible. So there's still some of that hangs out there from people who come in and say, "Do I need this anymore?" Well, guess what? You need it again now. So auto loan interest now is deductible, but there are some caveats. One is the maximum auto loan interest deduction is $10,000, which is still a nice deduction, but it has to be on a domestically assembled car. And so, how are you going to find that out? Well, you could research on the internet, but most assuredly, if your dealer is selling a car that's subject to the $10,000 auto loan interest, they're not going to not let you know. They will let you know, and it will be prominent that, hey, your auto loan interest qualifies, and they'll probably get it from the manufacturer, and that'll be clarified. So I think that information is going to get out there quick, which means you don't have to track down where your car is assembled, or where the car you're looking to buy is assembled. That'll be put out there, and it'll be readily available information sooner or later. So that starts in 25, by the way. So if you bought a loan or bought a car in 2025 and have auto loan interest on it, it might be deductible. So it's starting this year.
So anybody who's bought a car so far this year, even if this was before this bill passed, you should be looking into where that car was assembled, because this could apply to you retroactively.
Yeah, I think that's it. Is you want to know that you have your auto loan interest together, and then start looking around on, it'll be starting with Google, I think, as a search, but eventually, like I said, this information will be out there. You won't have to come up with this on your own. It'll be published information on many websites.
Okay, great. Thank you for that. Eric, we talked about this a ton all throughout as the legislation was coming through. The Senate, the House, they went back and forth. The SALT cap. Talk to us about where we ended up with the SALT cap and what people need to be thinking about now that it is different.
Yeah. So back in 17, the SALT cap was put in place as a $10,000 cap for deduction on state and local taxes. That's what SALT stands for. It's not that spicy ingredient that you put in your meat. It is actually means state and local tax deduction. So that's the SALT moniker. That $10,000 cap was a significant reduction to what otherwise people were paying in those state and local taxes. If you think about it, your state income taxes, certain amount, your real estate taxes fall under there, some personal property taxes fall under there. So there's all sorts of taxes that were gathered under the state and local tax deduction that used to be fully deductible. And then that SALT cap came in 2017, and it said $10,000. That's the limit. Well, that has been raised to $40,000. And why that's important is because what happened in 17 when that was limited to 10,000 is a lot of people couldn't even itemize their deductions anymore, which means they were limited in the deductions they could take so much that they ended up taking the standard deduction. So they didn't even itemize their deductions, which means they didn't look at charitable contributions and maybe mortgage interest. Now, though, that the SALT is $40,000 cap, that means a lot more of your taxes are deductible, which means when you add it with your other itemized deductions like charitable contributions and mortgage interest, could be over your standard deduction, means you could be itemizing your deductions again. So some things maybe you didn't have to worry about from 17 through now in itemizing your deductions, you now have to start considering, including this auto loan interest deduction, by the way. You now have to start considering, hey, are these deductions now available to me now that that SALT cap has been raised from 10,000 to 40,000? Note that that SALT cap, though, also is phased out. It phases out starting at $500,000, which is quite a high income. But if you're over $500,000, you want to look and see how the phase out affects you. If you're under $500,000 in income, you have up to $40,000 of SALT deductions that you can take. So you want to take a look at that with your charity and your mortgage interest. You might be itemizing again this year where you hadn't in the past. It might mean your tax preparation got a little bit more complicated.
Okay,
but beneficial.
Yeah, exactly. So and could conceivably, if now this makes more sense to itemize, this could be where charitable contributions and a strategy around that is going to make a lot more sense to have that be a part of the conversation.
That's right. This is It'll be more work for tax preparers, which
Yay.
is, I think, good if you're in the business, or bad if you don't like doing work. Then it's not so good.
All right. Well, so actually, so talking about charitable contribution, talk to us about what charitable contribution above the line means. That's another one of the enhanced deductions that was in this one big beautiful bill act.
Yeah, that's right. What charitable contributions are part of your itemized deductions, and we're only deductible if you itemize your deductions. And again, in the past, those were very much limited in part because of the SALT rule we just talked about. But now, even if you take the standard deduction and you don't itemize, there still is a deduction available up to $2,000 for charitable contributions. So this is an above the line deduction, which means you don't have to itemize to take it. So a lot of folks that maybe did charitable contributions in the past, but were subject to these limitations, said, doesn't really matter. I don't need my receipts. I'm not itemizing my deductions anyway. Well, now actually you can, for cash charitable contributions, you can take up to a $2,000 deduction for those above the line, even if you don't itemize your deduction. So again, it's a little more record keeping on the individual's part, but it could be worth something to them on the tax return to have a $2,000 deduction. If they're doing those itemized, or if they're not doing itemized deductions, but they're still doing some charitable contributions. So it's something that I think, again, it offers a little more tax benefit, but you have to keep track of it and be able to turn it into your tax accountant at the end of the year.
And Eric, we're doing a webinar, I think, next month on for nonprofits. I would imagine this is something nonprofits are going to love. This is going to incentivize people to want to give more. I mean, in theory, should make it more advantageous for people to donate to charity. Is that right?
Yeah, that's right. I mean, I think there's and this is you wonder why all these tax rules are in there. They are to incentivize behavior. This is it's a fairly, I think, documented study that these financial benefits or not can affect behavior, and deductions for charitable contributions do tend to affect behavior and do elicit more charitable giving.
Great. So before we get to the mailbag, I just want to give a quick reminder. I know we talked about it last week, but we have created a central resource for everything related to the One Big Beautiful Bill Act. So just head to sva.com/OBBA. That's OBBBA, 3 Bs, where you'll find biz tips, a recording of our webinar from last week, and other key information on how these proposed changes affect business owners, investors, and individuals. Eric, let's now jump into the mailbag. Our question this week, and just remind everybody, you can send us your questions at bizbeat@sva.com or head to our website at sva.com/bizbeat. So this week's question, Eric, is the heavy vehicle deduction back in play now that OBBBA has passed?
Yeah, and when I read this, I think what they're referring to is there's like what's sometimes called the SUV rule. It's for vehicles that are used in business, heavy vehicles that are used in business. There's a special rule for vehicles that are 6,000 pounds gross vehicle weight rated, GVWR. That's not the curb weight. That's their gross vehicle weighted rate, which means how much they can be loaded with, basically, including the car. And so you're not looking at curb weight, you're looking at GVWR, and you're looking for 6,000 pounds or more. And what does 6,000 pounds or more get you? Essentially, starting in 2025, you can now write off the full cost of that vehicle to the extent you're using the full vehicle for business. So if you're using it part for business and part for personal, you have to do some calculations there. But assumingly, if you're using it all for business, that can be 100% write-off. And you do it through a combination of both Section 179 and bonus depreciation. Now that bonus depreciation is back at 100%, that's how you get this magic of getting a full write-off for SUVs. You'll probably see this advertised sooner or later as well, as you can get this full tax deduction out there. And if you think about what SUVs are gross vehicle weight rated 6,000 pounds or more, it's certainly the big ones like the GMC Yukon or Chevy Suburban, the Ford Expeditions, but they don't have to be that big. The Ford Explorer is 6,000 pounds gross vehicle weight rated. So these are more mid-sized SUVs that tip the scales when you measure that GVWR at more than 6,000 pounds. So if you get one of those and it's all used for business, you can get 100% deduction for that vehicle this year. It works that way because a bonus depreciation law change now is at 100% starting January 19th this year. If you got it before January 19th, sorry, it probably won't apply. But after January 19th, if you get your vehicle after then, now it's going to apply. And if you get one of those vehicles for business, you possibly have a full write-off for 2025.
Great. So that's great news for business owners who can use that. So I guess the main takeaways for this week, Eric, phase outs. We talked a lot about that. Tariffs are always changing, and give to charity. And then probably most importantly, what I heard from you is make sure to listen to the car dealership ads, because that's where you're going to get a lot of your good information, right?
That's where I get my tax advice from, is the car dealer.
Perfect. That's where you go for it. You heard it here first, everybody. All right. Well, that is a wrap on this week's Biz Beat by SVA. Make sure to subscribe on Apple Podcasts, Spotify, or on YouTube so you don't miss an episode. And don't forget to visit sva.com/OBBBA to explore more about the legislation that we've been talking about here. And we can also schedule a presentation for your group or organization if you'd like a customized presentation on that. As always, I just want to remind everybody that what we discuss here is general information. For advice specific to you and your business, reach out to your advisor. If your advisor is not at SVA, reach out to me and we can talk about how to make you a client. Thanks again for listening, and we will see you next week on the Biz Beat by SVA.
It's the Biz Beat by SVA, breaking down the news of the day. From tax tips to business trends, smart insights from trusted friends. The Biz Beat by SVA.